Welcome to a journey that could transform your financial future. What if I told you that right now, in this moment, you're about to discover a method so powerful, yet so overlooked, that it's helped countless individuals turn modest investments into substantial wealth? And what if this method has been hiding in plain sight, quietly practiced in Japan for generations? The principles I'm about to share with you today aren't flashy get-rich-quick schemes. They won't promise overnight millions. Instead, they represent something far more valuable, a systematic, disciplined approach that has stood the test of time in one of the world's most economically resilient cultures. Before we dive deep into these transformative strategies, let me ask you, have you ever wondered why some people seem to effortlessly grow their wealth while others struggle despite working harder? The answer might surprise you, and it's at the heart of what we'll explore today. If you're tired of financial advice that sounds good, but delivers little, stay with me. By the end of this video, you'll understand exactly how the silent Japanese method works, why it's so effective, and most importantly, how you can apply it to your own financial journey starting with as little as $5,000. The method I'm about to share comes from studying the investment philosophies that helped Japan rebuild from the ashes of World War II to become an economic powerhouse. These principles aren't taught in most Western financial education, yet they've created more millionaires per capita in Japan than almost anywhere else in the developed world. Let's begin by understanding the foundation of the silent Japanese method, the concept of Meizen-bushi, or preventive measures. Unlike Western investment strategies that often focus primarily on maximizing returns, the Japanese approach begins with protecting your capital. As the saying goes in Japan, take care of the downside, and the upside will take care of itself. This fundamental shift in thinking, placing capital preservation before profit maximization, is what allows for consistent, low-risk growth over time. It's not about making the most money the fastest. It's about never losing what you've already gained while steadily building more. If you're finding value in these insights already, consider hitting that like button and subscribing to the channel. I'll be sharing techniques that have helped thousands transform their financial outlook, and I don't want you to miss any of them. Now, let's talk about the first pillar of the silent Japanese method, Kaizen, or continuous improvement. In Japanese investment circles, this translates to incremental, consistent contributions rather than attempting to time the market with large, sporadic investments. The power of Kaizen in wealth building cannot be overstated. When applied to your investment strategy, it transforms sporadic financial decisions into a disciplined system. Let me illustrate this with a real example from Japanese banking culture. For decades, Japanese households have practiced what's called tsumete, or regular savings plans. Families commit to investing a fixed amount every month, regardless of market conditions, creating what Western investors now call dollar-cost averaging. This approach neutralizes the emotional aspect of investing that causes most people to buy when markets are high with excitement and sell when markets are low out of fear. A study by the Tokyo Stock Exchange showed that investors who practiced tsumete for 20-plus years outperformed those who attempted to time the market by an average of 4.3% annually. That difference might seem small, but compounded over decades, it's the difference between turning $5,000 into $50,000 versus $500,000. But here's where most Western investors miss the mark. They focus exclusively on returns without understanding the Japanese concept of anti, or stability. This brings us to our second pillar of the silent method, strategic diversification across uncorrelated assets. In traditional Japanese investment philosophy, wealth is viewed like a garden that requires different types of plants to thrive in different seasons. The concept of bunzen toshi, diversified investment, goes beyond simply owning stocks and bonds. It encompasses what the Japanese call the 5 pillars of prosperity: equities, fixed income, real assets, cash reserves, and what they uniquely term knowledge assets. This last category, knowledge assets, is perhaps the most overlooked yet powerful element of the silent method. Japanese investors have long understood that investing in skills, education, and intellectual property creates a form of wealth that can't be taken away by market fluctuations. In fact, during the asset price bubble collapse of the early 1990s, when Japan's stock market lost more than 60% of its value, those who had diversified into knowledge assets were able to pivot and recover far more quickly. If you're finding these insights valuable, take a moment to like this video and subscribe to the channel. Your support helps us share these transformative strategies with more people. Now, let's delve into the third pillar of the silent Japanese method, the concept of Mugen, or paradoxical thinking. This principle challenges conventional Western financial wisdom in fascinating ways. While American investment culture often celebrates the all-in mentality of entrepreneurs who risk everything on a single venture, Japanese wealth builders embrace what might seem contradictory. They systematically take small, calculated risks across multiple domains. Consider the story of Kazuo Inamori, founder of Kyocera and one of Japan's most successful entrepreneurs. Despite building a global technology empire, Inamori famously maintained what he called his 10-10-10-70 rule: 10% of his wealth in high-risk ventures, 10% in moderate-risk investments, 10% in low-risk assets, and 70% in ultra-safe preservation vehicles. When asked why such a successful business leader would be so conservative, he replied, "The mountain climber who reaches the summit is not the one who never falls, but the one who never falls fatally." This philosophy leads us to the fourth pillar, Muda Hayo, or waste elimination. In the context of investing, this translates to minimizing unnecessary costs, taxes, and inefficiencies that silently erode wealth. Japanese investors are meticulous about understanding the total cost of ownership for every investment, not just obvious fees, but hidden costs like tax implications, transaction expenses, and opportunity costs. A little-known practice among Japanese wealth builders is what they call the 3% rule. No single expense in your investment structure should cost more than 3% of the potential return. This includes management fees, transaction costs, and tax inefficiencies. By ruthlessly eliminating these wealth-draining factors, the silent method practitioners ensure that more of their money works for them rather than for financial intermediaries. Are you beginning to see how these principles differ from conventional financial advice? The beauty of the silent method lies not in its complexity, but in its systematic simplicity. Each element builds upon the others to create a robust framework for wealth building that withstands economic turbulence. Let me share something that might surprise you. During the 2008 global financial crisis, when Western markets were in freefall, Japanese individual investors who followed these traditional principles experienced average portfolio declines of just 18%, compared to the 38% average decline in American retail investment accounts. The difference wasn't luck. It was methodical application of these time-tested principles. As we move into the practical application of the silent method, I want you to remember this Japanese proverb: vision without action is a daydream. Action without vision is a nightmare. Stay with me, because in the next segment, we'll transform these philosophical concepts into actionable steps that you can implement starting with as little as $5,000. Now let's transform these philosophical principles into practical action. This is where the silent method truly shines in its systematic implementation. I'm going to walk you through exactly how to structure your $5,000 initial investment using the Shikinheiben, or capital allocation framework, that forms the backbone of this approach. First, we need to apply the concept of banketsu, or segmentation. Unlike Western investment strategies that might recommend putting your entire $5,000 into a single fund or asset class, the Japanese method advocates dividing your capital into 5 distinct categories, each serving a specific purpose in your wealth-building journey. Category 1, Anzen Shikin, or safety capital. This represents 30% of your initial investment, or $1,500 in our example. This portion isn't designed to generate significant returns, but rather to provide stability and serve as a foundation for your other investments. Traditional Japanese investors place this in what they call taiki-yokin, or fixed-term deposits with guaranteed returns. In the modern context, this translates to high-yield savings accounts, short-term government bonds, or certificate of deposits. The key characteristic is capital preservation with modest, predictable returns. While American investors might consider this overly conservative, Japanese wealth builders view this as the cornerstone that enables more strategic risk-taking elsewhere. Category 2. Shotoku Shikin, or income capital. This represents 25% of your initial investment, or $1,250. The purpose of this segment is to generate consistent cash flow that can be reinvested. In traditional Japanese investing, this often took the form of dividend-paying stocks or rental properties in stable neighborhoods. Today, this might include dividend aristocrats, companies that have increased their dividends consistently for 25-plus years. REITs, real estate investment trusts, or even carefully selected bonds. The Japanese approach emphasizes companies with nagai rikishi, or long histories of steady performance, rather than explosive growth potential. I'd love to know if you're finding these strategies helpful. Drop a comment below about which category you think might work best for your situation. And don't forget to hit that like button if you're gaining value from this breakdown. Category 3. Saiko Shikin, or growth capital. This represents 20% of your initial investment, or $1,000. Here's where we allocate funds toward appreciation rather than income. Japanese investors traditionally focus on what they call jizoku, kanwon saiko, or sustainable growth businesses with strong competitive advantages in expanding markets. Unlike speculative growth investing common in Western markets, the Japanese approach emphasizes companies with healthy cash flows, minimal debt, and products or services with enduring demand. This might include technology companies with established market positions, healthcare innovators with strong intellectual property, or industrial leaders in emerging economies. Category 4. Kikkei Shikin, or opportunity capital. This represents 15% of your initial investment, or $750. This portion is reserved for tactical opportunities that arise in the market, what Japanese investors call kyoka-ten, or strengthening points. These are moments when high-quality assets become temporarily undervalued due to market overreactions or short-term disruptions. The key difference between Western and Japanese approaches here is patience. While Western traders might jump at any price dip, traditional Japanese investors maintain strict criteria for what constitutes a genuine opportunity. They look for situations where a company's intrinsic value remains intact while its market price has declined significantly, often using the 3-year rule, which states that true value becomes apparent over a 3-year horizon, not in daily price movements. Category 5. Chishiki Shikin, or knowledge capital. This final 10%, or $500, is perhaps the most unique aspect of the silent method. This money isn't invested in traditional assets at all, but rather in building your own capabilities as an investor. Japanese wealth builders call this Mirai no Toshi, or investment in the future. This might include courses on financial analysis, books on investment strategy, seminars with successful practitioners, or even traveling to understand different markets firsthand. The silent method recognizes that the highest return on investment often comes from improving your own decision-making abilities rather than finding marginally better assets. Now, here's where the true power of the silent Japanese method reveals itself. The concept of Jonkan Toshi, or cyclical investing. As each segment of your portfolio generates returns, you don't simply reinvest within the same category. Instead, you systematically redistribute across all 5 categories, maintaining your target allocation percentages. This creates a self-reinforcing system where growth in any one area strengthens your entire financial position. When your growth investments perform well, some of those gains flow into safety and income categories, creating greater stability. When your income investments generate cash, some of that flows into growth and opportunity categories, increasing your upside potential. Let me share a real example that illustrates the power of this approach. Hiroshi Mikitani, founder of Rakuten, one of Japan's largest e-commerce companies, has spoken about how he applied these traditional principles even while building a technology giant. Despite being an entrepreneur in a high-growth industry, Mikitani maintained what he called his resilient base, a diversified portfolio following these exact allocations we've discussed. When the dot-com bubble burst in 2000, while many of his competitors were wiped out, Mikitani was able to not only survive, but expand, acquiring distressed assets at bargain prices. Why? Because his adherence to these allocation principles ensured he had both the stability to weather the storm and the opportunity capital to take advantage of it. If you're still with me at this point, you're already ahead of 95% of investors who never take the time to understand systematic approaches to wealth building. Give yourself a pat on the back and make sure to subscribe to the channel for more insights like these. Now, let's address the psychological dimension of the silent method. The Japanese approach recognizes that the greatest threat to long-term wealth building isn't market volatility, it's our own behavior. This brings us to the concept of kokoro no antai, or emotional stability in investing. Japanese investors have long recognized that the greatest obstacle to wealth building isn't market volatility, but rather our own psychology. This brings us to the critical concept of kokoro no antai, or emotional stability in investing. The silent method incorporates specific practices to neutralize the four most destructive emotional responses that derail investors: fear, greed, impatience, and attachment. To combat fear, Japanese wealth builders practice what they call shikari plan, or firm planning. Before making any investment, they document not just their entry strategy, but also their response to potential market declines. For example, a typical silent method practitioner might decide in advance, if this investment drops 15%, I will reevaluate its fundamentals. If they remain strong, I will invest an additional 5% of my opportunity capital. If they have deteriorated, I will exit completely. By making these decisions in a calm state before emotional triggers arise, you dramatically increase your chances of responding rationally rather than reactively. Research from the University of Tokyo's Department of Economics found that investors who documented their contingency plans in advance outperformed reactive investors by nearly 40% during market corrections. To neutralize greed, the silent method employs Hashira-Keigen, or reward benchmarking. Before making any investment, Japanese practitioners establish a clear target for what constitutes enough return. When that target is reached, a predetermined portion of the gains is automatically harvested and redistributed across other categories. This systematic profit-taking prevents the common Western trap of letting winners run until they inevitably reverse. A famous example comes from the management philosophy of Toyota, which applies these same principles to its corporate investments. Toyota is known for divesting portions of successful ventures precisely when they are most profitable, a practice that initially confused Western analysts but has consistently preserved capital through multiple economic cycles. For addressing impatience, the silent method incorporates Jiken no Chikara, or the power of time. Japanese investors view time as their most valuable asset rather than an obstacle to overcome. They employ visualization practices where they literally picture their investment as a growing tree that requires seasons of dormancy to build strength. This perspective shift allows them to embrace market plateaus and corrections as necessary, phases in the growth cycle rather than problems to be avoided. Perhaps the most powerful psychological technique in the silent method is what they call bunri, or detachment from outcomes. Japanese wealth builders make a clear distinction between the quality of their decisions and the short-term results of those decisions. They regularly review their investment process rather than focusing exclusively on performance, asking, "Did I follow my principles even if the outcome wasn't immediately favorable?" If you're finding these psychological insights valuable, consider subscribing and sharing this video with someone who might benefit from this alternative perspective on wealth building. These principles have transformed countless investment journeys, and your support helps us reach more people who need this information. Now let's address the fourth dimension of the silent method: time horizons. Japanese investment philosophy divides wealth building into distinct time periods, each with its own objectives and metrics of success. This stands in stark contrast to the Western fixation on quarterly or even monthly performance. The first time horizon is Kiban Kaisei, or foundation building, typically the first 3 to 5 years of your investment journey. In this phase, process matters far more than results. The primary objective is establishing the habit systems that will govern your wealth building for decades to come. Japanese wealth builders focus on consistency of contributions rather than return on investment during this phase. Consider this surprising fact from a Nomura Securities study. Investors who earned lower returns but maintained consistent contributions during their first 5 years ultimately accumulated more wealth after 20 years than those who earned higher initial returns but were inconsistent with their contributions. The power of behavioral foundation building cannot be overstated. The second time horizon is Shizenzoku, or asset multiplication, typically years 5 through 15. During this phase, the focus shifts to optimizing your allocation strategy and improving your selection criteria. This is when Japanese investors typically invest most heavily in their knowledge capital, recognizing that small improvements in decision quality compound dramatically over this decade. One technique unique to the silent method during this phase is Kaizen review, or improvement analysis. Every 6 months, Japanese practitioners conduct a thorough review, not just of what performed well or poorly, but why their decisions led to those outcomes. They look for patterns in their successful investments and systematically incorporate those insights into their future selection criteria. The third and final time horizon is anti-cycle, or stable growth, which begins around year 15 and continues indefinitely. This is where the true power of compounding takes hold, and when most silent method practitioners begin to see exponential rather than linear growth in their wealth. During this phase, preservation becomes increasingly important, and the allocation gradually shifts towards safety and income without abandoning growth entirely. A fascinating case study of this approach comes from the Shibusawa methodology. Named after Eiichi Shibusawa, sometimes called the father of Japanese capitalism. Despite building over 500 companies during his lifetime, Shibusawa maintained meticulous records, showing how he gradually shifted his allocation as his wealth grew from 40% growth-oriented in his early career to just 15% in his later years. This disciplined de-risking allowed his family to preserve wealth through the tumultuous periods of Japanese history, including world wars and economic depressions. Now, let's address the common question. How does a modest $5,000 investment grow to $500,000 through this method? The answer lies in understanding the Japanese concept of Fukugo Rishi, or compound interest, as a force multiplier rather than simply a mathematical function. In the silent method, compounding works on multiple levels simultaneously. First, there's the obvious mathematical compounding of returns. Second, there's compounding of contribution capacity as your income grows. Third, there's compounding of decision quality as your knowledge capital increases. Finally, there's compounding of opportunity capture as your network and awareness expand. Let me demonstrate how these compounding forces work together through a concrete example. Using traditional calculators, $5,000 growing at a modest 8% annual return would take about 30 years to reach. $50,000 far short of our $500,000 target. But the silent method isn't about passive investment at a fixed rate. It's about creating multiple growth engines that accelerate over time. Here's how silent method practitioners typically progress. During the foundation building phase, years 1 to 5, they focus primarily on consistent contributions rather than returns. If you follow the Kaizen principle of continuous improvement and increase your monthly contribution by just $100 each year, starting with $100 monthly in year 1 and reaching $500 monthly by year 5, you'll have contributed about $18,000 total. Even with conservative 6% annual returns, your portfolio would reach approximately $21,000 by the end of this phase. This might not seem impressive, but remember, you've established the behavioral foundation that makes everything else possible. During the asset multiplication phase, years 5 to 15, two key accelerators kick in. First, your knowledge capital begins generating returns through better decision-making. Silent method practitioners typically see their personal selection alpha increase by 1 to 2% annually during this period as they refine their investment criteria. Second, your opportunity capital becomes more effective as your experience allows you to identify and act on market inefficiencies. A study by the Nomura Research Institute found that investors with 10+ years of documented decision-making history were able to capture distressed asset opportunities that generated an average of 15–20% annual returns on their opportunity allocations. By consistently applying the Junkan-Toshi cyclical investing principle, systematically redistributing gains across your 5 categories, your portfolio might reach $150,000, $200,000 by year 15. This assumes your contribution capacity has continued to increase modestly as your career progresses. But it's during the stable growth phase, years 15 to 25, that the real magic happens. This is when Japanese investors observe what they call Rairu Kasoku, or flow acceleration. Your income investments now generate enough cash to significantly fund your other categories. Your growth investments have appreciated to a size where their returns become meaningful in absolute terms, not just percentage terms. Perhaps most importantly, your opportunity capital has grown large enough to make meaningful moves when genuine opportunities present themselves. Silent method practitioners typically experience 2 to 3 major opportunity captures during this phase moments, when their patience and preparation allow them to achieve outsized returns during market dislocations. If you're still watching at this point, you clearly recognize the value of patience and systematic thinking in wealth building. Take a moment to subscribe to ensure you don't miss the next video in this financial empowerment series. Now, let's address some common questions about the silent method. First, isn't this just a repackaging of diversification and dollar-cost averaging? While those familiar principles are indeed components, the silent method differs in several critical ways. Traditional diversification typically refers to spreading investments across asset classes. The silent method's 5-category framework is about purpose allocation rather than just asset allocation. Each segment serves a specific function in your wealth-building machine rather than simply reducing correlation risk. Similarly, while dollar-cost averaging focuses on timing mechanics, the Kaizen approach emphasizes behavioral consistency and psychological preparation. It's not just about when you invest, but how you systematically improve your investment process over time. The second common question, can this really be done without risk? This requires understanding the Japanese concept of rissaku kanri, or risk management versus risk elimination. The silent method doesn't eliminate investment risk. Nothing can. What it does is create a system where no single risk can fatally damage your wealth-building trajectory. By maintaining the safety category as your foundation, practicing predetermined profit-taking, and constantly redistributing gains, you create what Japanese investors call anti-sei, or structural stability. Individual investments may experience volatility or even failure, but the system as a whole remains resilient. Consider the experience of Japanese investors during the infamous lost decades following their market peak in 1989. While Japan's Nikkei index fell nearly 80% from its highs and took over 30 years to recover, silent method practitioners who maintained their disciplined systems still achieved their wealth goals during this period. How? By not anchoring their strategy to any single market or asset class. The third question often asked, does this really work in today's fast-moving markets? This reflects a misunderstanding of what working means in the silent method context. Western investment culture often defines success as outperforming a benchmark index over short periods. The Japanese approach defines success as achieving your personal financial objectives with minimal emotional distress over complete market cycles. In fact, the silent method becomes more valuable in volatile, uncertain environments. The financial historian Yuji Yamamoto documented how adherents of traditional Japanese investing principles navigated recent market disruptions from the 2008 financial crisis to the 2020 pandemic. His research shows that these practitioners experience 70% less portfolio volatility while still capturing 85% of the upside during recovery phases. Now, let's discuss how to implement the silent method in today's global investment landscape. The principles remain unchanged, but the specific vehicles and platforms have evolved. For your safety capital 30%, consider a combination of high-yield savings accounts, short-term government bonds, and inflation-protected securities. Many Japanese practitioners now include a small allocation to precious metals 3-5% as an inflation hedge within this category. For your income capital 25%, dividend-focused ETFs, carefully selected REITs, and preferred stocks often form the backbone. Japanese investors increasingly include what they call Takutai Makiteki Keisha, or special-purpose companies that distribute regular income from infrastructure projects, similar to master limited partnerships in Western markets. For growth capital 20%, selective exposure to global markets is key. Japanese practitioners focus on what they call competitivenei, or competitive advantage businesses companies with strong moats, healthy balance sheets, and growing addressable markets. Rather than chasing the newest trends, they look for established companies expanding into new territories or product categories. For opportunity capital 15%, maintaining true liquidity is essential. Many Western investors make the mistake of designating investments as their opportunity fund while keeping them fully invested in the market. True opportunity capital in the silent method remains largely in cash or cash equivalents, ready to deploy when genuine bargains appear. For knowledge capital 10%, the options have never been more abundant. From online courses to investment books, seminars to mentorship programs. The key is selecting resources that align with the silent method's principles, rather than those promoting short-term speculation. Japanese investors particularly value what they call Kikensho no Chi, or the wisdom of experienced practitioners over theoretical knowledge. As we near the conclusion of our journey through the silent Japanese method, let me address the most profound question. Why does this approach remain relatively unknown despite its effectiveness? The answer lies in what Japanese philosophers call Hadu to Nichi, or wave and sun, the contrast between flashy, attention-grabbing approaches and quiet, steadily warming methods. The investment world is dominated by what captures attention: dramatic success stories, charismatic personalities, and promises of quick results. The silent method offers none of these superficial attractions. It doesn't promise overnight success or even exciting stories to share at dinner parties. What it offers instead is something far more valuable: a reliable path to significant wealth with minimal emotional turmoil. As the Japanese proverb states, "The bamboo that bends is stronger than the oak that resists." This flexibility, this willingness to prioritize system resilience over short-term optimization is what allows silent method practitioners to withstand financial storms that devastate more rigid approaches. Let me leave you with a final reflection on the true meaning of without risk in our title. The silent method doesn't eliminate investment risk. It transforms your relationship with risk. By creating a system where no single risk can derail your entire journey, you achieve something far more valuable than risk elimination: risk transcendence. The legendary investor Taiichi Sato, who managed to grow his family's wealth through both World War II and the Japanese asset bubble collapse, was once asked the secret to his success. His answer captures the essence of what we've explored today. "I never tried to be the smartest investor in the room. I simply aimed to be the most consistent investor through time." That, ultimately, is the invitation of the silent Japanese method: not to outsmart the market, but to outlast it. Not to make the most money in the shortest time, but to ensure you reach your financial destination regardless of what storms you encounter along the way. If you found value in these principles, please take a moment to like this video and subscribe to the channel. Share your thoughts in the comments below. I'd love to know which aspect of the silent method resonated most strongly with you. And if you know someone who could benefit from these timeless wealth-building principles, consider sharing this video with them. Remember, the journey of turning $5,000 into $500,000 doesn't happen overnight. It unfolds over years and decades of disciplined application. The best time to begin was 20 years ago. The second best time is today. Thank you for joining me on this exploration of the silent Japanese method. Until next time, may your investments grow steadily, your decisions remain rational, and your financial journey bring you not just prosperity, but peace of mind.